Welcome to this episode of the Cocktail Investing Podcast, where we look to distill everyday noise into clear investing signals. I'm Chris Versace, Tematica's Chief Investment Officer, and from time to time we have special guests who join us, us being myself and Lenore Hawkins, Tematica's Chief Macro Strategist and my co-host for the podcast. So we have people who join us to help give extra insight into the economy, certain industries and other things, other happenings that are shaping the market that investors need to know, that we use as part of distilling all the everyday noise into clear investing signals. And this week we were lucky enough to speak with Mark Hamrick, who's the Senior Economic Analyst and Washington Bureau Chief at Bankrate. And I have to say, both Lenore and I love Bankrate because it's a fantastic source of all sorts of information. Not just as you might think its name hints at, where you can find stuff on housing prices and mortgages, retirement, credit cards, debt and that sort of thing. But there's all sorts of data, surveys, and perspectives that can be kind of interesting and in many cases helpful to our own investment, our thematic investment lens, but to others as well. So we wanted to talk to Mark to get his take as a person who works inside the Beltway and looks at all the economic data, to get his input and his perspective on where he sees the economy, what he sees going on with the consumer, and we were very interested in that given our cash-strapped consumer investment theme, but also some insight into the Fed, Chairman Powell, and some other things. So with that, here's our conversation with Mark Hamrick, Senior Economic Analyst and Washington Bureau Chief of Bankrate. Mark, you were just saying about trying to keep me in line, and Lenore does a very good job of it. But kind of like I think you were tweeting something earlier about the JOLTS report, and you were kind of saying that, hey, we have continued to have more openings than jobs filled, I think, right?
Right.
So, and Lenore, that's one of your big data points that you like to watch, right?
Spots. Yeah, the JOLTS report is, I think, one of the most useful of all the labor reports.
There's a lot of, it's like a buffet. There's something for everybody there.
There really is. Okay, so we need to get to this on the podcast. So
yeah.
Well, we're surprise, we're already rolling, my friends. So with that, let me just say, hey, Mark Hamrick, thanks formally for joining us here on Cocktail Investing. Mark is the Senior Economic Analyst and Washington Bureau Chief at Bankrate. And Lenore, you and I, we tend to look at Bankrate quite a bit. I say that because, one, for our investment themes and economic data, there's a whole host of information, but for consumers and investors as well, there's all sorts of data out there on what to do with your home, whether it's the mortgage, retirement, credit and debt, all sorts of stuff. And Mark, correct me if I'm wrong, but Bankrate is, I think they say they're one of the largest aggregators of financial information.
That's right. Basically began roughly 4 decades ago doing rate surveys, essentially across the interest rate environment, specific to U.S. geographies. And then that was leveraged pre-internet into basically newsletters of the snail mail variety. And then the internet came along and enabled a much more efficient distribution mechanism, not to mention the ability to personalize the experience to your local setting. So we are constantly doing rate surveys, and we have a lot of history doing that. And it's great for all of us, especially those of us that are employed by the enterprise, to be able to have access to all this information, and then to talk about how ultimately it's intended to help people accomplish their financial goals, as we like to say, help them live life's financial journey. And whether we know it or not, if we have just a modest level of functionality in this economy, or better than that with any luck, all this information ends up being tremendously useful. And then there's obviously the broad brushstroke piece about the macro economy and the financial markets.
Totally agree. I mean, I look at Bankrate and I see a host of data, a lot of informative surveys and perspective. Just this morning, getting ready to talk to you, I looked at one of the more recent surveys, which, Lenore, I think you'll find dovetails very well with our cash-strapped consumer theme. And the gist of the survey was, why are half of all Americans not taking a summer vacation. And 50% said they simply just can't afford it. The other 22% said that they can't afford to take off work. And that's one example of the many surveys you guys do and a lot of data. I think there was a data point I saw, Mark, that said roughly 20% of Americans have no savings, and that's part of the financial security index that you guys publish.
Yeah, absolutely. And, it's interesting because before we came on here, I was speaking with basically a colleague in business and financial journalism. And I basically said that I feel like to some degree, it's been part of my mission over these many years, basically, 4 decades of doing this in one form or the other, is trying to, number one, raise consciousness on the part of the general public and individuals in terms of what they need to know. But there's also, to some degree, a fair amount of error correction that needs to occur. And what I mean by that is, now we're just a number of days out from the most recent employment report, where we learned that the monthly gauge of unemployment took that to 3.8%. And we continue to have what might be called respectable, if not robust, jobs creation now 9 years into the economic expansion. So a lot of people, including generalists in journalism, will want to look at all that and basically say everything's great, right? And by any number of different metrics, they'd be right. But I want to remind them, by virtue of the data you just cited, as well as something the Federal Reserve generated within the last 3 weeks, is that, well, maybe looking at that report, a lot of things are great, but there's also 40% of the American public which is living paycheck to paycheck.
Right.
And so this is where the stars sometimes align, but sometimes they are not well aligned. And I feel like it's our job to help try to piece some of that together, or at least to point out where there are some modest contradictions or apparent contradictions.
Totally agree with you. And, we are data junkies. What we like to say is you can't rely simply on the headlines. You got to get deep into the weeds and really see what the data is telling you. And Lenore, as Tematica's chief macro strategist, does a wonderful job on that. She actually called out, I think it was with the January employment report, they were talking all about wage growth. And I think, Lenore, you were one of the first people, certainly one of the first people that I knew, that called out the problem with that report, because the data was not really reflecting all workers, just a very small microcosm of those workers. So Mark, I think we agree with you wholeheartedly. I just want to pause there and just ask you a question. Why is it that a lot of the quote-unquote talking heads will just focus on the headlines if we know that that's not really painting a full picture?
Very good question. And I think part of it is that, frankly, it's like so many other things in life these days, where it's sort of people take, I may be well off on the number, but you get the idea. They take 20 seconds to understand something and act as if they just read a 500-page book.
I'm sorry, Mark. Mark, I'm sorry. I didn't hear what you were saying. I was busy tweeting.
Yes. And that holds true to just about, everything that we talk about, whether it's relative to the economy or the financial markets. Is very often there's a desire to talk about the shiny new thing, where ultimately the tried and true, well understood thing is the thing that we need to come back to.
Okay, so it sounds to me, I hate to put it like this, but there almost needs to be a simpler form of financial education so people will actually understand what's actually happening.
Well, this has become one of my missions in life, to be honest with you, and we're talking about wearing a number of hats. It's important for Bankrate. It's important for me as an individual. It's important for me as president of the Society for Advancement of Business Editing and Writing, which is the leading organization of financial journalists. And we have a number of partnerships there, including with the National Endowment for Financial Education, which is really intended to try to underscore the importance of financial literacy, but also to point out that as a country, we've been failing with financial literacy relative to our peers across the globe in recent years. And I would argue that this then informs how it can be that we have elected leaders who ultimately make bad decisions. And as we just learned, the Social Security Trust Fund is, again, sort of the unintended orphan of the lack of a conversation here, where, the political environment these days tends to focus on, dare I say, things that ultimately don't have a lot of ultimate meaning and resonance. And yet, here we go with millennials now wondering whether there'll even be a Social Security fund for them. So all these things do reinforce. And I think to the degree that we can try to basically underscore their importance, I think it's something that we can add value to the conversation, to the extent that we do have conversations anymore in this country.
Lenore, I think you were about to say something.
Yeah, that's right up our alley. With it. One of the things I find unbelievably frustrating is, although I do entertain myself a little bit with it, is whenever a piece of data comes out, like the BLS report, the JOLTS report comes out, how fast you will see hitting Twitter, somebody has written an article. and it is bam. And I look at it, I'm like, I haven't even finished reading it. Like I have not gone through the data and compared the points. Like, how in God's name are you actually producing something that I know you couldn't have spent more than 10 minutes writing this thing, and yet it's presented as something valuable, and then that becomes the big headlines because it's the race to be the first one out, and then that makes all the headlines, and then people just see the headlines because we live in this, like you said, 22nd world, where that's all the time I'm going to put into understanding something. And then this complete fluff becomes fact. And then decisions are made on that fluffy fact.
Well, for the sake of full transparency, I've probably been involved in some of that virtual instant production of analysis myself. But what I would say is that as I step back from all this and the very specific kind of, I'll use the word content that we're talking about here, I think that as consumers of information, which we hope that we all are, we all need to try to do a better job of managing the sort of digestion of information in the short term and in the long term, right? And so I think that we've unfortunately recently trained our brains to, sort of be constantly ingesting the stuff which seems to not resonate over the long term, and take less time to, as the saying goes, lean back and try to maybe spend some time with the 200 or I should say the 2,000 word account on something. But, and I just did that over the weekend with a great story I'll use as an example in the Washington Post, which was fairly long, but it talked about how the rising interest rate environment is beginning to take a toll on family farms in the United States, right? Mm-hmm. And so, the talking point is that interest rates are still relatively low and they're just coming off historically low levels. But, the point in the Post was, well, for a farmer where these rates are approaching now 6% for basically $1 million loan that they have to take out to get their business done for the year, this is beginning to basically make their margins evaporate, right? And so this is where the point comes where, in the coming days, if all goes as planned, I'll be in the news conference where the chairman of the Federal Reserve holds court. And, there's the piece where all journalists sort of want to try to impress one another by asking a question which is highly technical. And then there's the piece where basically we need to step back and say, wait a minute, we need not to be reinforcing each other's view of the world, but perhaps actually try to differentiate as to, well, okay, rates have been rising, but how much are savers really getting right now, and why is that, and what are the unintended consequences? And that does come then with the attempt to try to slow all this down just a little bit to say, here's where the 10-year Treasury yield is at this very moment. But but there are some things that are longer trend lines that we also probably need to pay some attention to.
So, Mark, let me ask you a question. My understanding is that when the Fed actually releases certain reports, there's a group of economists and journalists that are actually on site, and they might receive the data maybe 10, 15 minutes ahead of everybody else, gives them time to prep. so that, as Lenore is saying, the minute something drops to the public, you guys are able to respond. Is that really what happens?
Yeah, so there are a number of different iterations of that here inside official Washington, and the way that they occur of most relevance to, let's say, the news-consuming public is, for example, the terminology for that setting is a lockup, not like a jail, but in a way it is like a jail because once you're in, you have to stay and all that kind of thing. And there is some vetting of getting those people in there so that there's no accidental leaking of that information that can obviously move markets. So there is that for the FOMC meeting each and every time. There's also that for the testimony that is delivered by the Federal Reserve Chair or Chairman now, as well as the monthly employment report. There's been some changes to those lockups over the years because of either literal incidents where the information has leaked and caused a problem. At least for the last several years, there's not been a known incident where there has been such, let's say, an incursion. But yeah, there obviously, if you were an ill-minded actor and wanted to move a market by getting access to that information, you could certainly do that. And then, of course, you'd probably have to deal with a federal investigation and the prospect of a jail term. So
yeah,
other than that,
I think I'm going to say no thanks.
Yeah, exactly.
So how do you see the Fed having changed with the new chairman?
Yeah, good question. I think we're still trying to figure that out to some degree. I mean, I see it from any number of different perspectives, including even the way that the Fed staff seems to interact. I think that it's been less violent a change than it might have appeared, if only to some degree because of the fact that it was President Donald Trump who sought to make a change, and we know that carries a range of, dare I say, risks and opportunities. But I think the intention there was to basically make a virtual change in name only, so that, one of the things that I've tended to say about this president is that it has often been the undoing of all things Obama. And so what was the easiest thing to do with the Federal Reserve appointment was to not reappoint Janet Yellen and then just try to put someone in there basically who doesn't represent a revolutionary approach. And I think that's essentially been the case. But, there was a non-public, but on the record background call with White House staffers when they were explaining that change. And the best that I could piece together on their, let's say, logical explanation for the change, which obviously was not necessarily fully transparent, meaning, it's not like everything that was known was necessarily uttered. But the explanation that was given was that Jerome Powell has more practical experience with financial markets and enterprises. Mm-hmm. I think, frankly, though, that there's also, if you move away from the undoing of all things Obama piece, I think there's also the piece where the critics of Chair Janet Yellen would have said that she was primarily ensconced as a labor market economist who, in the view of some, might have thought that she would have a tendency to then, in their view, err more on the side of applying medicine to heal those things which are not necessarily entirely healthy in the job market, and perhaps then not being as attendant to the issues, let's say, associated with the lack of vibrancy being experienced on the part of small or mid-sized financial institutions, as we've seen in evidence with the so-called reform of the Volcker Rule more recently and other similar changes, meaning that when the major response to the financial crisis was enacted in legislation, being the massive Dodd-Frank legislation, that was obviously, number one, somewhat of a hurried response, but also there are always unintended consequences to legislation, which takes some time to understand. And so more recently, there's been a response on the part of elected leaders to try to perhaps level the playing field for smaller and mid-sized financial institutions, obviously banks and credit unions. And so I think that so far so good with Jerome Powell, but we're only a few months into his tenure, and I think it's highly likely that he, if he even serves to the end of his term, that he will be presiding in the midst of a recession, and history also tells us that there will likely be a financial crisis, or at least there's a possibility that we don't know how it presents itself, not to mention geopolitical events around the world. And so right now he's still in the virtual honeymoon period. The stock market's only modestly off the highs. So let's see how it goes when the going gets a little tougher.
Well, Mark, just kind of sitting there with your role in Washington for Bankrate, again, dual roles, senior economic analyst and Washington bureau chief. What's the read in D.C. as far as what the Fed thinks about the economy?
Well, I would say that it's been, I think, very much a continuum in the sense that the outlook for interest rates over the intermediate and even near term hasn't really changed that much over the last year or so. Obviously, now, as we speak, we're just a number of days away from not only the news conference, but the updated set or summary of financial projections from those individual but anonymous members of the Federal Open Market Committee, and because they won't dare tell us who owns what dot on the because that would just be telling us too much. But
that is not my dot.
Yes, it's not. It's like me as a son. Nobody wants to take ownership. But I think right now, obviously, we're still down the path of normalization. There haven't been, I would say, significant negative unintended consequences apparently associated with rising interest rates. But if you look at either the projection over the next couple of years, obviously you see that if all goes sort of as planned and if all goes well, that we still obviously have a ways to go before we basically top out in the, let's say, on the federal funds rate. And we had a bumpy ride earlier in the year in the financial markets, in part because of that employment report that you referenced, where Lord forbid we might actually be seeing some more substantial wage growth, which obviously brought in some inflation fears. I guess I'll say that I'll believe it when I see it. If we actually get down the next couple of years with a number of as many as expected rate hikes as seem to be transmitted in these intentions, because I think to some degree we've been conditioned to be cautious by the Fed in, let's say, 2 or 3 years ago, where it was sort of like a dog with a stick and a bone in front of it, where we kept running for the next interest rate hike that didn't ever seem to be within reach. And we obviously have now checked off a number of those rate hikes more recently, because both the markets and the economy seem to be essentially absorbing them quite well. But I'd also remind us, in the sense of more of a long-term approach, that the would-be benefits of the tax cut begin to diminish substantially about not quite 2 years out. And so that is when perhaps it gets a lot more dicey, not to mention the fact that and get ready for your sedative or adult beverage, but another presidential election.
That'll be fun.
Let me just cut you off there for a second, Mark, because there's a whole bunch of things that you just kind of mentioned, and one of the ones that jumped out to me, Lenore, was to paraphrase you, which I like to do, is you were talking about the recent past, the last 2-3 years, Mark, and I think the data has been, and this is, correct me if I'm wrong here, Lenore, we've been driving with one foot on the brake a little bit, push pull.
Yeah, I think one of the challenges, I think, for investors is that while we're hitting the accelerator pedal with fiscal policy, with monetary policy, we're kind of tapping the brakes. And I think from an investor perspective, one of the big challenge is, since the financial crisis, investors have been punished severely for taking out any kind of protection. Any kind of insurance in your portfolio has cost you dearly. And those portfolio managers, the professionals who put that in, were punished, and a lot of them lost clients, or they underperformed and would lose money. Individuals who put any protection into their portfolio, they were punished. And so bit by bit, people have learned, don't protect yourself. And in fact, go further out the risk curve, and that has manifested itself in a lot of buy the dip, right? Because the dip was simply buying opportunity because there is no real risk out there, because the central bankers around the world will all chip in and they will come and save the day. To me, that is not a sustainable dynamic in the markets. And I look at Powell, and he seems to me, so I wanted to get your read on this, he seems to me to be a lot less interested in looking at the stock market as a report card for himself compared to prior Fed chairs. Because I would say Bernanke, Yellen, maybe to a slightly lesser extent, certainly Greenspan, were very concerned with how the stock market viewed them.
Right. Mark,
and they seemed to.
Sorry, Lenore. I was just going to say, before you answer that, Mark, let's keep in mind too, just to add to that list, Lenore, Trump seems to, or had been using the stock market as a barometer for what he did in his first year. Yet he seems absently,
not much tweeting about it.
Yeah, I know. It's very strange. Market goes sideways. We don't hear a lot about that. But sorry, Mark.
But does tweet about the jobs report before it's released. That was good.
Are you saying he should be investigated, Lenore?
I said nothing.
So is the question then, is Bernanke as concerned about
Powell,
the stock market?
Powell.
I'm sorry, Powell. Is how concerned is Powell about the stock market? I don't think I think broadly speaking, those who lead the Federal Reserve care mostly about the financial markets only as they then have significant impact on the real economy. And so I think that's the lesson that one learns after paying significant attention to both FOMC statements, but also dynamic situations where, time after time, whether it's Bernanke, Yellen, or Powell, where they are asked, well, what's the impact of the tax cut? And if she said it once or he said it once, they've said it 1,000 times, and that is, we'll see how it affects the economy. And so as we sit here, I have yet to see the tremendously robust response, for example, on the part of the consumer, not to mention the fact that gasoline prices have obviously gone higher, and we're seeing some other things like tariffs, which are also diminishing the potential beneficial impacts of a tax cut for working class Americans. So I think really ultimately, I think that they tend to be more agnostic toward the performance of the stock market than we would tend to think. But obviously, if you get into a crisis such as with a firm that basically went belly up in Bernanke's term, long-term capital management, or have a near-death economic experience such as the financial crisis or Great Recession. Those are things which are entirely different because they have systemic risk. And so undoubtedly, if we have a truly significant downturn in the stock market, some things will probably begin to make some strange sounds during that time, meaning that the would-be shadow financial system begins to exhibit some things that we didn't know were going to happen. But the reality is that, unfortunately, that's the only way to test for all that, is to go through that experience. And that's where there's sort of the real-time response, as we saw with, for example, Treasury Secretary Paulson and Federal Reserve Chair Bernanke, where we went from a fund which was meant to buy up sagging financial assets to injecting capital into the banks just to keep them sound, and that seemed to happen basically in a moment's notice back in the day.
So, Mark, let me segue here. Sorry, circle back to what we were talking about earlier about financial education and the like, and I want you to strap on your senior economic analyst hat and answer this question. A lot of economic data out there. We've seen the Atlanta Fed, boost their GDP now forecast, and they're, in our view, historically very, very off the mark. The New York Fed has done the same. What is either the Mark Hamrick or the Bankrate view on the economy today?
Well, number one, as a matter of quote unquote practice, we don't have, let's say, like a firm's view where, or let's say a brokerage or a securities firm, we don't issue.
No, that's fine, Mark. That's fine. It just means you're on the hook. That's all.
No, well, that wouldn't be the first time, but I can tell you what we've broadly been thinking, and that is, that we'll probably, it could well be that we're seeing, for example, the yield of the 10-year Treasury in a range that will continue on through the end of the year, where we had that spike up to well above 3%, and has since been backtracking and backing and filling. But in terms of the economy itself, I don't think that there's a tremendous reason to back away from essentially the consensus, for example, where you have growth percolating under 3% this year, well below the 4% target that the president enunciated as someone who was campaigning for the office. But I think in terms of the consensus view among economists, I don't know of virtually anybody who's substantially credible who thought that we have sustained 4% growth in the United States anyway. So my own personal sort of view is that I think we could get the unemployment rate down to the 3.5% range if all goes well over the next year and a half or two. That's more improvement than the consensus suggests. And the reason why I think that is because we continue to crank out a substantial number of jobs on this on a monthly basis, basically averaging 190,000 jobs a month over the past year, and I believe slightly less than that over the past 3 months. And, there's round agreement that we only need to create roughly 100,000 jobs just to basically march in place with the job market. And yet with all the encumberments that we're experiencing, including the shortage or the perceived shortage of workers, but obviously some real shortages in sectors and geographies, we're still cranking out a decent number of jobs. So that to me suggests that there's more slack. And to be honest, I think the Federal Reserve has had to basically make that adjustment over time as well, because we're now well below where it believes so-called full employment is anyway. And so that suggests that that wasn't full employment because we're well below it.
Are there issues, Mark, in the unemployment report? You hear, different things about labor force participation rate. You hear things about the mismatch between full-time jobs and part-time jobs, yet the report seems just to count jobs. So is it, and I'm going to ask you a question that I know that Lenore gets, that I get. Is it time for that report to be overhauled?
Well, let me take a broader approach to that question, because first of all, we know on a worst case scenario that we had, Jack Welch, the former CEO of GE, say about 4 or 5 years ago that basically there was a conspiracy to generate false numbers, and that was absolutely incorrect. So that's the worst case scenario of an approach to that question. The reality is that, number one, you have civilian non-political appointees involved in this creation process, as well as robust ongoing conversations between the private sector and the reporting agencies, which essentially are broad brushstroke, the Labor Department and the Commerce Department. And, I have sort of an ability to, go to conferences or go to those departments or even talk with the Commerce Secretary within the last couple of weeks, who the first thing Wilbur Ross said about one of the surprises that he learned about being at the Commerce Department, which has census within it and then generates things like GDP and other important numbers, was he said, "I was surprised by the high degree of professionalism and the commitment on the part of these civilian workers, how they're generating these numbers." So to more specifically answer your question, what I'd say is, by all means, the data can always be improved. And I think there's constantly a process to try to improve the data. But there's also a disconnect between the elected leaders in Washington and what those agencies are able to do, because they're either keeping their funding level or cutting it. And yet it's very important to have access to this data, because it's necessary for the performance of basically all of us, whether a business or an individual, to know what's going on in both the economy and in the markets. And to the degree that we have access to better information, and I do think that the information does continue to improve over time, we all are beneficiaries of that. And to underfund it or to suggest that it's part of a conspiracy or something that's somewhere in between ends up having a malicious impact on what we all need as consumers and just people who are existing within the U.S. economy.
Mark, I hear that, and I think to myself, something that Lenore and I talk about quite a bit, and we wrote about it in our book Cocktail Investing, which this podcast is based on, which is you can't rely on any one singular data point. And it seems to me that people who are assessing whether it's job creation or inflation, that you really want to take a hard look around and look at a number of different metrics and kind of triangulate around what they collectively are telling you. That's my view on it. And I know on that perspective, Lenore, I'll let you do the intro on this, but we are hearing a lot more about inflation these days, and I'm curious to see what Mark thinks about that on what the Fed may do. 3 rate hikes, 4 rate hikes. I even heard from somebody that there's a possibility there could be as many as 5 this year.
Mm-hmm. Lenore, you going
no
first?
To you.
Okay. Well, let me address first of all the question about trying to have a broader view, and the broader view is one where it helps to get out. For example, I'm in Washington. It helps to get beyond the Beltway. It just so happens, just to let you know a little bit about too much information about who I am. My parents were both from Appalachia. My dad's grandfather was a coal miner who died when my father was a young boy. My wife is from Niagara Falls, New York, which is basically a hollowed out urban area that barely survives in New York, at least on the New York side. And then I grew up in Kansas, and in the particular county I grew up in has the highest unemployment rate and the highest rate of opioid deaths. So here I am living in Washington, which benefits from federal spending, the $1 trillion spent in response to 9/11. And yet I know these things are happening elsewhere across the country. And so there isn't a day that goes by that I don't think about the people who are not living under the benefit of the federal government to some degree here in the Washington area. And so that's where it's important to come back to the Bankrate data that says that people are not saving enough for retirement and emergencies, or the Federal Reserve data that says that for 40% of the population, they would have difficulty paying a $400 expense. In terms of the outlook for inflation, this is another part where actually some of the data is sometimes less than elegant, because we know that in our everyday lives, I have a 26-year-old son who went to college and other things, and I know how much that cost, right? But yet, we've been living in a low inflation environment, but I can tell you that was a shock to the system when we paid for 4 years of college tuition for him. So that was a kind of personal inflation that the data doesn't embrace. And so, in terms of measuring the data, yeah, we've had a rising trajectory for inflation, and the expectations for inflation seem to be rising sort of year over year, maybe in the above 2.5% range through the end of the year. Let's see how the Federal Reserve continues to manage all of this. I think right now it's probably a safe assumption to say that the consensus, let's talk about the consensus. The consensus is roughly 3.5 rate increases this year. And that means that you can't have 3.5 rate increases. You have to either go to 3 or 4. I think 5 is way too ambitious at this point based on what we know. But I think if I had to go to the casino and place a $100 bet on where we end up, I think 4 is safe. But we also have midterm elections, and that will end up translating into at least some potential impact on fiscal policy, not to mention a whole lot else. And that there could be some market turbulence that gets associated with that then bleeds into the broader economy. And I'll say, just to sort of wind all that piece up, is that we are seeing in anecdotal evidence now, whether it's in the Beige Book survey from the Fed, the Institute for Supply Management surveys, that the tariffs are making a negative difference. And it's also bleeding into the inflation component and the cost of doing business, and consumers and businesses end up paying that. So that could end up being a negative headwind, which most headwinds are. Federal Reserve policy is no longer certain to be a positive for the U.S. economy, or I should say federal policy is no longer certain to be that, whether it's the uncertainty associated broadly with policy or the certainty associated with the trade issues and some other things. And so that would be what makes you back away from the 4 rate increases and maybe get you closer to 3. And I know some people could even come up with 2, but I think that's a bit of a that's a bit of a tough call at this point.
So, Lenore, I heard 4, then 3, maybe 4, 3. Mark, you're definitely living
like any good economist can have at least 3.
No, I said 4. I said I would bet on, if I had to bet, I'd bet on 4.
Okay, fair enough. Just one quick thing, Mark. Concerns about the consumer as interest rates go higher?
Well, not just interest rates, right? I mean, you have all these rising costs. You have the less than, I think, robust proof that the tax cut has made a substantial difference. And well, you see it, for example, in the housing market data, right? We coming into today, we had 8 straight weeks of declines in mortgage applications. We have year-over-year increases on a national basis in home prices of 5 to 6%.
With more to come.
Yeah, and in Seattle, the median price of a home is $800,000. And the other part is that home builders, for example, are more concerned about serving the market where people are moving up than they are to entrance to the housing market. So there are a lot of things that, again, don't necessarily speak to, the consumer price index as well as the reality that people are experiencing. So, yeah, rising interest rates, rising inflation, rising prices, those all cause challenges for the consumer. And as we know, average hourly earnings have barely risen slightly above 2.5%. And that means that the wage gains that people are seeing, at least by that measure, are barely, staying above the measured inflation. And that means that we aren't all making as much progress with our personal financial goals as we'd like.
Yeah, I think there's a saying about if you're standing still, you're actually falling behind.
Yeah.
Something along those lines. So,
yeah.
Lenore, anything else?
Well, I think we have to get to the single most.
No. It's two. Remember, because what's going on. So, Mark, you're in D.C. This is a very important question. Probably, in some respects, second most important question we'll get on the podcast today. Here it comes. Caps or the Knights?
Well, for all kinds of reasons, I have to like the Capitals' chances. If for no other reason, they're ahead 3-1 as we speak. My wife worked for a hockey team back in the day. We have friends in the industry. I hosted Coach Barry Trotz for an event here in Washington a few years ago. So I'm way in too deep to be able to side with what would be a historic performance if Las Vegas pulled off the championship. But, Washington is long overdue to reestablish itself as a champion in a major sport. So, and the other part is, in all truthfulness, the owner, Ted Leonsis, is as positive a person and a contributor to the Washington community as you could ever want a sports owner to be. And for those that follow the National Football League, that's not universally an experience of Washington sports ownership.
or in San Diego, where Lenore is based.
I can't even talk about my feelings towards the Chargers. Well, actually, not towards the Chargers, but towards Spanos. Spanos has become basically a dirty word in San Diego for having moved our beloved Chargers out and to Carson.
That's a tough one. I feel your pain. But yeah, I'm all in on the Caps winning. That's where we're hoping. Absolutely.
All right, Lenore, I'll let you ask the last question, but I'm just going to preface it with this. Mark's in Washington, and he's a journalist, so I expect a really good answer.
That's true. Well, so actually bringing up the Chargers does kind of segue nicely to the second question because it causes this favorite cocktail.
That's an easy one. Manhattan up with rye.
Excellent. Have you been out to the Mark? I don't know. You work inside the Beltway. I don't know if you live outside the Beltway. Have you made it out to Catoctin Creek in Purcellville?
I have consumed the product, but I have yet to get out there. But and to answer the other question, I do live outside the Beltway, but I toil midway between the White House and the Trump International Hotel and the National Press Building.
Okay. All right. Well, we'll have to see about expanding your horizons out to Purcellville, otherwise known as Lickerville, and see what we can do.
If you need me to do an on-scene report out there, I'm more than happy to
Excellent.
Take one for the team.
Excellent. Thank you, Mark. So listeners can continue to see your musings and insights as well as those from Bankrate at Bankrate.com. If they want to follow you on Twitter, I believe it's at Hamricks.com.
Hamrick-isms.
Hamrick-isms. I'm sorry.
Yeah. All right.
And then if people want to know more about SABEW, the Society for Advancing Business Writing and Editing, where can they go?
That's at SABEW.org. We're a not-for-profit, and you can also probably find some of that by way of either my accounts on LinkedIn or Twitter as well. So, we'd love to help people with their financial engagement at Bankrate, and obviously, the journalism world's an important one for all of us in keeping a robust democracy as well.
I can't think of any other way to end it, Lenore. Can you?
No, that was about perfect.
Thanks, everybody.
Thanks so much.
Thanks for having me. Great questions, and great to be with you. Thanks so much.